If you were held at gunpoint and had to choose between handing over your money or risking your life, chances are, you'd hand over your wallet. But when it comes to the daily grind, most of us unconsciously prioritize our money over our lives. We're stuck in a cycle of earning money from our jobs in order to buy things we don't need, and sacrifice our true priorities in the process. In this book, you'll learn about the path to financial independence, the ability to decide how to spend your time without relying on paid employment. Along the way, you'll see your financial history with clarity, liberate yourself from your pre-existing attitudes about money, and develop new financial habits that will melt away your debt and enable you to retire early if you choose. If you're like most people, you probably have no idea how much money has cumulatively passed through your life. In order to get a grip on your finances, you need to come to terms with your financial history. That's why the first step in transforming your relationship with money and reaching financial independence is to make peace with your financial past. Calculate your net worth by creating a personal balance sheet which tracks your assets and liabilities. Your liquid assets are anything that can be converted into cash. This includes things like money in your savings and checking accounts, stocks and bonds at the current market value, or even spare change in your glove compartment. Your fixed assets are everything you own, from major possessions like your car or house to items that could be sold at a garage sale. Next, calculate your liabilities, which are any debts, loans, or outstanding bills. Subtract this amount from the combined value of your assets to determine your net worth. If you want to transform your relationship with money, you'll need to challenge your assumptions about what you earn and spend. That way, you can reserve your life energy for the things you truly care about. So step 2 of the program is to get in touch with your present situation by calculating your real hourly wage and tracking your money. Start by making a table with 3 columns. Label the first column weekly hours, the second column earnings, and the third column dollars earned per hour. Next, add in the details based on your job. For example, if 40 hours per week nets you $1,000, then you earn $25 per hour. Now it's time to account for any adjustments. If you commute to work, include the time your journey takes as well as related expenses like gas, tolls, or public transportation fees. Calculate the money you put into buying clothes for your job and the time you spend shopping, getting dressed, or shaving for work. Going back to your table, add all the additional time to your weekly hours column. Next, subtract your expenses from your weekly earnings listed in the second column. Finally, calculate your real hourly wage. Now that you know your real hourly wage, you'll have a better idea of how much life energy your spending is worth. In order to truly understand your spending habits, start keeping track of every penny that comes into or out of your life. You need to understand exactly how you spend your money. Step 3 is to categorize your monthly spending. Group your expenses in ways that make the most sense to you. By tracking the precise categories of your spending, you might realize that your occasional restaurant meal has developed into a full-blown, expensive habit. Also create subcategories to track your spending for things like housing, transportation, and entertainment. Once you've itemized your spending categories, create a monthly tabulation that lists your subcategories. At the bottom of the table, include a section to list your income, with individual lines for any paychecks, bonuses, interest, or other earnings that might factor in. After you've entered your monthly transactions into each category, subtract your total spending from your total income to find out your monthly savings. By making minor adjustments to your spending, you'll be on your way to realizing it. That takes us to the fourth step in the program, evaluating your spending by asking yourself 3 questions. In some subcategories, you might find that you experienced so much fulfillment that you'd even consider increasing the expenditure of life energy. If that's the case, mark the subcategory with a plus sign. For subcategories in which you experienced little to no fulfillment, mark a minus sign. If the expense feels neutral, mark it 0. By objectively analyzing your spending, you might find that you're skimping on subcategories that bring you value while overspending on addictive habits, like buying shoes you hardly wear. The most important trick for continued success is to track your progress. That brings us to step 5 in the program, charting your progress with a graph of your income and expenses. On a large sheet of paper, draw a graph that you can hang on your wall to track your monthly income and expenses. The vertical axis represents money, and the horizontal axis represents time measured in months. When creating increments on the vertical axis, start with 0 and leave enough room for your income to double. The horizontal axis should track your progress for 5 to 10 years. At the end of each month, use 2 different colors to track your monthly expenses and your monthly income. Then, connect the points to the previous month's entry. Over the months and years, you'll be able to identify patterns and see your progress toward your financial goals. Frugality is about enjoying what you have. If you own 10 dresses and enjoy wearing them over the years, great. But if you're a compulsive shopper and are simply addicted to buying dresses that are hanging unworn in your closet, it might be time to lower that expense. While you've now gained awareness on your financial past and present, step 6 of the program is to consciously reduce your monthly spending. Consciously lowering or eliminating your spending is about intelligently using your life energy. There are a number of ways to minimize your spending. The most obvious is to avoid shopping. If you don't go into stores, you won't be tempted to impulse buy. To reduce the temptation to shop online, unsubscribe from promotional emails, be aware of marketing on social media, and develop a general habit of buying only what you need. The 7th step to transforming your relationship with money and achieving financial independence is about valuing your life energy and increasing your income. Consider this: is the life energy you're currently putting into your job a fair exchange for what you're receiving in return? Whether you're saving up to go to grad school, support your family, or get out of debt, seeking the highest possible pay in line with your health and integrity isn't about wanting more money just for the sake of it. It's about working toward a sustainable future. If you need $2,500 to cover your expenses, you could double your income by earning $50 an hour as a contractor instead of staying put at your $25 per hour desk job. Before you start investing, make sure you have enough money in the bank to cover 6 months of expenses. This liquid cash is your emergency fund, as well as the money you'll draw from for your monthly spending. Once you have at least 6 months of liquid cash in your bank account, consider opening a savings account. Now you can start the 8th step in the program, investing and tracking your additional savings. Unlike the income you receive from your job, your monthly investment income is the income that you receive from your capital. This involves any income you didn't have to work for, things like interest, dividends, rental checks, or business profits. Your investment income might include receiving rent from real estate or royalties from intellectual property, franchises, or natural resources. You could gain capital from selling an investment for an amount more than what you initially invested. But you'll most likely want to focus on earning interest or dividends by investing in bonds, mutual funds, or the stock market. In any case, it's crucial to learn about all your options before embarking on an investment path. By making educated choices, you'll ensure that your investments are as sustainable as your new attitude toward how you spend your time and money. You'll be living more intentionally, even before you reach your financial goals. Thank you for watching. Please grab your copies now, kindly subscribe and stay tuned for more book discussions.